Hi, welcome to the third mini lecture for Chapter 2. Now we left off with Learning Outcome 2-2, and we were talking about how direct materials and direct labor get accumulated on the job cost sheet. But we really couldn't talk about applied manufacturing overhead at that point, so we're going to talk about it in Learning Outcome 2-3, which is calculating a predetermined overhead rate and using it to apply manufacturing overhead costs to jobs. Our notes tell us that unlike direct materials and direct labor, which can be directly traced, conveniently and accurately traced to individual jobs using our source documents, manufacturing overhead cannot be directly traced to specific jobs. If you remember, manufacturing overhead consists of things like indirect labor, which might be the security guard or the plant manager or the production supervisor. It consists of indirect materials, factory rent, factory depreciation, factory insurance, etc. These things cannot be directly traced to the job. So manufacturing overhead must be assigned or allocated to jobs using a predetermined overhead rate and an allocation base. Now, why do we have to do that? Why can't we just use receipts from paying rent, or perhaps take the actual hours of janitorial labor and split it up over the jobs that we worked on? Well, the difficulty is using monthly actual overhead amounts would result in variations from month to month. For example, heating costs for the winter months in a factory that's located in New York would be higher in the winter months than the summer months, and air conditioning might be used in the summer months, but perhaps the rates would not be equivalent. So products would vary in cost from month to month. Perhaps the same exact products would vary in cost based on seasonal variations. And the other reason is that total actual overhead, is not known until the end of the year. And therefore, we wouldn't be able to cost any products if we waited until the end of the year. You wouldn't be able to assign a good sales price to be able to cover costs. So what we have to do is estimate how much total manufacturing overhead we will incur during the year. And then we're going to have to allocate that based on something that we can trace to individual jobs. So we need to determine an allocation base. It should be something that causes or drives the cost, which means a measure that causes or influences the amount of overhead that is incurred. And usually, something that can be easily traced to a job might be direct labor hours. And please add this to your notes because I forgot to add it. The three most common cost drivers or allocation bases would be direct labor hours, direct labor cost, or machine hours. I'm going to switch over to some pages in the textbook because I think they do a very good job of explaining this process. Okay, so this is page 55. And as I just mentioned, it says, because manufacturing overhead cannot be directly traced to a specific job, those costs must be assigned or applied using a predetermined overhead rate, and there are 3 steps to do it. The first step is to determine the allocation base, something that causes the cost or drives the cost. So we said that it could be direct labor hours, which could be easily traced, direct labor cost, which could be easily traced, or machine hours, which could be easily traced. Those are the 3 most common cost drivers or allocation bases. I'm going to flip the page now to page 56. And in this case it says because home remodeling is a labor-intensive business, direct labor hours or direct labor cost is the most appropriate cost driver. So what we're going to do is estimate the total manufacturing overhead cost that we will incur for the entire year and divide that by the estimated total cost driver. This is also called the allocation base. Now the next step is to actually do that calculation. So in our example here, it says to take the total estimated overhead for the year, $150,000, divide that by the estimated allocation base or cost driver, which in this case is direct labor hours, and that overhead rate becomes $15 per direct labor hour. This is the predetermined overhead rate. So if I flip back to page 55, we've determined the allocation base is direct labor hours, and we've calculated the predetermined overhead rate at $15 an hour. The third step is to apply overhead to jobs so that we can have an amount here by multiplying the predetermined overhead rate by the actual value of the allocation base or cost driver. So find out how many actual direct labor hours. In this case, we've got 28 here so far. And then we multiply that by the predetermined overhead rate. But it could be that we have more than one laborer working on that. So our hours on this side may be different. Okay, so that $15 means that's the amount of overhead we should apply for every hour of direct labor to cover all of the indirect costs of the job. Okay, so the predetermined rate, $15 an hour, times the actual cost driver. And that will give us the applied overhead for that job. Okay, so looks like we've got just Bill we have to account for. So if we look at Bill's labor ticket, we're going to multiply by 28 hours times the rate to find the overhead applied to job 27, and then 8 hours times the overhead rate to apply to job 28. So if we look back on the job cost sheet for 27, we will add $420 to that job cost sheet, and then we would add the three amounts to get the total job cost. So let's add those three up. I'm going to take my ancient calculator here, and let's add those three amounts. $1,750 in direct materials, $700 in actual direct labor, and then applied overhead is $420, and that will total $2,870 in total costs for that job. Direct material, actual, plus actual direct labor, plus applied manufacturing overhead of $420, which would go here. Let's try this. And by the way, our notes take you through the same process, but I think the book did a really good job of doing that. Here's our formula, estimated total manufacturing overhead cost divided by estimated total cost driver or allocation base, which could be one of the three. We calculate the rate, and then we apply it based on the actual amount of the cost driver or allocation base. Now keep in mind that because the predetermined overhead rate is based on estimated data, the applied manufacturing overhead is most likely not going to be the same as the actual manufacturing overhead cost incurred. And we're going to be talking about that in Learning Outcome 2-5. But let's take a moment now to get a little practice. Get out your worksheets, and we are going to do exercise 2-18. It says Verizox Corporation uses a job order cost system with manufacturing overhead applied to products based on direct labor hours. This is really important because it tells us what the allocation base or cost driver is. At the beginning of the most recent year, the company estimated its manufacturing overhead cost at $300,000. We need that number. They estimate direct labor cost was $400,000 and direct labor hours were estimated at $20,000. Now remember, it says that the rate should be based on direct labor hours, so that's what we're going to use when we calculate the rate. Actual costs for the most recent month are summarized here. So the first thing we're asked to do is calculate the predetermined overhead rate. And to do that, we take our estimated total manufacturing overhead cost, which means dollars, and divide by our estimated total allocation base, which is the same as the cost driver. So in our case, the estimated overhead was $300,000, and the application or allocation base is direct labor hours, and they estimate that at 20,000 hours. When I divide, my allocation base or application base is, my predetermined overhead rate is $15 per direct labor hour. So I will take that rate, the predetermined overhead rate, and multiply the actual direct labor hours by that rate to apply overhead to specific jobs. Okay, so our next step is they want us to calculate the amount of applied manufacturing overhead. To figure that out, we're going to take the predetermined overhead rate. I'm going to abbreviate that POHR, predetermined overhead rate, times the actual cost driver, which would be the allocation base, and that will give us our applied overhead. Okay, so we said the predetermined overhead rate is $15 per direct labor hour, and we have to multiply that by our actual direct labor hours, and fortunately, we're given those hours right there. It says actual costs, and there's the direct labor hours, 1,500 hours. And that's going to give us $22,500 of applied manufacturing overhead costs. Now in the next step, they're asking us to calculate actual manufacturing overhead. So let's go through this list and determine what would be actual manufacturing overhead cost. Well, indirect labor, factory labor would be $4,500. That would be included. Indirect materials for the factory, that should be included. Factory rent, factory supervision, factory depreciation, factory janitorial work, factory insurance, those are all costs that occur in the factory. General administrative salaries and selling expenses, those are period costs. They do not belong as part of manufacturing overhead. So we're going to add up those that I have just put in a bracket here. That will give us our actual manufacturing overhead cost, and that totals $25,300. Now in mini lecture, for the Learning Outcome 2-5, we're going to be learning about over or underapplied overhead. So first we need to know how to record those actual manufacturing overhead costs and how to record the application of those costs, and that will occur in Learning Outcome 2-4. So we'll see you in a few minutes for that.